Breaking overnight, US warplanes bomb 3 Iranian nuclear sites. President Trump hails a spectacular military success, but investors are bracing for oil at triple-digit prices and a flight to financial safe havens. In the next 10 minutes, we'll unpack what's happened, why the markets are rattled, and what history tells us may come next. Just after midnight local time, US forces joined Israel's air campaign, destroying enrichment facilities in Natanz, Fordo and Arak. According to US officials, Trump told Americans the sites were completely and totally obliterated and warned Tehran that all options remain on the table if it does not sue for peace. Iran's foreign minister shot back on X, promising everlasting consequences. The strikes landed on a Saturday night US time, when major exchanges were closed. But you can still take the market's pulse on weekends through crypto and Middle East bourses. Ether, widely seen as the retail risk barometer, dropped 5% within hours, extending losses to 13% since Israel's first retaliatory strike on June 13th. Meanwhile, regional stocks were surprisingly calm. Qatar's QSI, Saudi Arabia's Tadawul, and Kuwait Premier all opened fractionally higher, while Tel Aviv's TOR 125 carved out yet another record that suggests traders are assuming a contained scenario of for now. Energy desks aren't nearly as sanguine. Brent futures have already climbed 18% since June 10th, touching a 5-month high of $79 a barrel before the bombs fell. Analysts at MSD Marquee warn that if Iran retaliates by harassing tankers in the Strait of Hormuz choke point for a fifth of global crude prices, could set us on a path toward $100 oil. Higher oil means broader inflation. Oxford Economics estimates that a sustained $100 barrel could push US CPI to 6% by year-end, erasing hopes of a Fed rate cut in 2025. Every extra $10 at the pump siphons roughly $60 billion in US consumer spending over 12 months, money that won't go to restaurants, vacations, or back-to-school laptops. Equity investors face a familiar dilemma: sell first, ask questions later, or treat geopolitics as noise. Looking back at 14 major Middle East shocks since 1990, Wedbush finds the S&P 500 down just 0.3% in the 3 weeks after the event, but up to 0.3% 2 months later. Still, veteran portfolio manager Mark Spindle warns, uncertainty is going to blanket the markets. Americans everywhere are now exposed. Translation: expect a spike in the VIX, heavier put buying, and defensive rotations into utilities and healthcare. The greenback has tumbled all year on doubts about US exceptionalism, but when bullets fly, old habits die hard. Strategists at Interactive Brokers say the first knee-jerk is usually lower treasury yields and the firmer dollar. The question is whether that bid sticks once the cost of a protracted US deployment becomes clear. Remember how the dollar slid after the 2003 Iraq invasion. Gold could be the cleaner play. It's up 11% year to date and tends to outperform when real yields fall on growth fears. Some corners of the market love higher oil. Integrated majors like Exxon and Chevron, US shale drillers in the Permian, and tanker owners such as Frontline. Defense contractors think Lockheed Martin, Northrop Grumman often pop when missiles fly. On the flip side, airlines bleed. Jet fuel is the number to cost after salaries, and carriers can't raise fares fast enough when hedges run out. Retail and consumer discretionary also suffer as households tighten belts. Jamie Cox at Harris Financial argues that the same display of force that spooked traders might push Tehran toward the negotiating table, limiting the oil spike to a matter of days. The logic: with its enrichment program annihilated, Iran has lost leverage and may seek sanctions relief rather than risk more damage. But that hinges on Iran's domestic politics and whether hardliners view restraint as surrender. Early statements from Tehran, all options on the table, don't exactly telegraph capitulation. Let's game out 3 plausible scenarios for the next 30 days. Contained clash: Iran fires symbolic missiles at US bases, then enters back-channel talks. Brent spikes to $90, then retraces to $80. Stocks recover by August. Probability 45%. Hormuz harassment, fast boats, mines, and drone swarms snarl tanker traffic. Insurance costs soar, pushing Brent to $105, and global CPI up another 0.8 percentage points. Fed adopts hawkish pause. Probability 35%. Regional spillover, proxy militias hit Gulf infrastructure. Israel answers with ground ops. And the US commits carrier strike groups for months. Oil tests $130. Global recession odds jump above 50%. Probability 20%. Remember 2019? When drones hit Saudi's Ebcake facility, Brent gapped 20% on the open, but gave back half within a week of repairs advanced. Or 2012, when Israel threatened Iran's Natanz site, oil flirted with $125. Yet the S&P ended the year up 13%. Markets often over-discount worst-case outcomes, then mean revert once logistics and diplomacy kick in. So what can individual investors do on Monday morning? Check exposure if your portfolio mirrors the S&P 500. Energy's only 4%. Consider whether that underweights the risk of an oil super spike. Stagger trades, volatility tends to peak in the first 48 hours. Use limit orders instead of market orders to avoid paying panic premiums. Watch the bond oil spread if Brent rises, but 10-year yields fall. That signals stagflation, fears time to tilt toward quality stocks and cash flow positive real assets. Stay liquid, geopolitical sell-offs often reverse quickly. Having dry powder lets you buy assets that overshoot to the downside. Behind every chart is a human story, families in Tehran bracing for retaliation, sailors steering tankers through narrow straits, and consumers worldwide wondering how they'll afford the next fill-up. Markets may rebound, but lives disrupted by conflict don't heal on a ticker tape. B-roll, split screen, Tehran street market, tanker crew at sea, US family at gas pump. Key signals in the next 72 hours. Iran's official response, will it target shipping, bases, or nothing? UN Security Council emergency session could reveal whether Europe backs more sanctions or pushes for talks. Oil futures curve, if the spread between 1 month and 6-month Brent widens dramatically, that means traders expect prolonged disruption. We'll keep tracking every market ripple and geopolitical twist. Hit subscribe for our up-to-the-minute breakdowns and let us know in the comments, what's your biggest worrying? Oil inflation, stock volatility, or something else entirely? Thanks for watching and stay informed. If you found this breakdown helpful, don't forget to subscribe to Dynamic Trends for more in-depth analysis on global events, market reactions, and financial insights that matter. And be sure to check out the link in the description for 10 top-rated Amazon products our viewers love right now, handpicked just for you.